Bollinger Bands are a powerful, versatile tool, widely used by traders across various markets. They serve as a visual tool for traders, providing insights into potential trading opportunities. They help assess price volatility, giving traders a sense of the market's current state of flux. They show if prices are relatively high or low, indicating potential overbought or oversold conditions. This can be invaluable for making informed decisions. The bands consist of 3 lines, each playing a critical role in the indicator's functionality. An upper band which acts as a dynamic resistance level, a lower band serving as a dynamic support level, and a middle band which provides a baseline for price movement. This trio forms a dynamic envelope, encapsulating price action and providing context. This envelope adapts to changing market conditions, expanding in times of high volatility and contracting during periods of calm. The middle band is a simple moving average, a fundamental component of the bands. This SMA is usually set to 20 periods representing the average price over the last 20 time intervals. The upper and lower bands are placed strategically around this moving average at a set number of standard deviations, a statistical measure of dispersion. They are commonly set at 2 standard deviations away from the SMA, a balance that captures most price movement. Standard deviation measures price volatility, quantifying the degree of price fluctuations. As a result, the bands expand and contract as volatility changes, reflecting the market's dynamic nature. Most price action stays within the bands, indicating a normal range of price fluctuation. This makes them a useful framework for analysis, providing a visual guide to potential buy and sell zones. The SMA represents the medium-term trend or average price, offering a broader perspective on price direction. The upper band sits 2 standard deviations above the SMA, acting as a ceiling for price movement. The lower band sits 2 standard deviations below, providing a floor for price action. These parameters can be adjusted, allowing traders to customize the bands to their specific needs. However, the default settings are widely used, providing a reliable baseline for analysis. The band's containment principle, where price tends to stay within the bands, is key to their interpretation. Understanding each line's role is crucial for effective use, enabling traders to make informed decisions. The envelope's flexibility is what makes Bollinger Bands so valuable, adapting to various market scenarios. They visually highlight periods of high and low volatility, making it easy to identify potential trading opportunities. The bands help traders spot potential price extremes, signaling possible reversals or continuations. This structure forms the basis for many trading strategies, offering a versatile framework for market analysis. Bollinger Bands adapt to the market, unlike static indicators, providing a more dynamic perspective. They offer a clear visual way to interpret price action, simplifying complex market dynamics. Mastering their use can give traders a significant edge, enhancing their ability to navigate the market successfully. The simple moving average, often abbreviated as SMA, is a fundamental tool in technical analysis. It's a cornerstone indicator that provides traders with a clear view of price trends. It is the backbone of Bollinger Bands, serving as the central line around which the bands are plotted. At its core, it calculates the average price over a specified period, commonly set to 20 days, but adaptable to various timeframes depending on the trader's strategy. To find the SMA, you simply add up the closing prices for the chosen period, whether it's days, weeks, or even months. Then, you divide that sum by the total number of periods included in the calculation. This gives you the average price for that time frame. As new price data becomes available, the oldest price in the series is dropped out of the calculation, ensuring the average reflects the most recent market activity. This continuous updating process results in a smooth, flowing line that visually represents the average price movement over time. The SMA's averaging effect effectively filters out the random fluctuations and daily market noise that can obscure the true trend. By smoothing out these short-term variations, the SMA helps in revealing the underlying trend of the asset. Shorter SMAs, calculated over fewer periods, react more quickly to price changes, making them more sensitive but also potentially more choppy. Conversely, longer SMAs, calculated over a greater number of periods, are smoother but slower to respond to immediate price fluctuations. The 20-period SMA is often favored because it strikes a reasonable balance between sensitivity to price changes and overall stability. Its primary function is to smooth out the price action, providing a clearer picture of the prevailing trend. This smoothing effect is invaluable for clearer trend identification, allowing traders to make more informed decisions. The SMA's length has a direct and significant impact on how it behaves and appears on the chart, influencing its responsiveness to price movements. It's a straightforward yet remarkably effective method for tracking the general direction of price movement over a chosen period. The SMA's inherent clarity and ease of understanding make it accessible and useful for traders of all experience levels. Its widespread adoption stems from its simplicity in calculation and the ease with which it can be interpreted, making it a staple in trading strategies. Within the context of Bollinger Bands, the SMA serves as the critical anchor, providing the foundation upon which the entire structure is built. It acts as the central reference point from which the upper and lower bands are calculated and plotted, defining the expected range of price movement. This pivotal role underscores the SMA's essential nature for effectively utilizing Bollinger Bands in trading and analysis. The simple moving average, or SMA, is the bedrock, the very foundation upon which Bollinger Bands are built. It's the starting point for understanding how these bands function and how they can be used in trading strategies. It also serves as the centerline of Bollinger Bands. This centerline isn't just an arbitrary line, it's a dynamic measure that reflects the average price over a specific period. It represents the fair value consensus over the chosen period, offering a snapshot of where the market generally believes the price should be. This consensus is crucial for identifying potential overbought or oversold conditions. Prices often fluctuate around this middle band, sometimes testing it as support or resistance before continuing their trend. This makes it a key reference point for traders looking to gauge the strength and direction of a trend, and to identify potential entry and exit points. The upper and lower bands are calculated directly from the SMA, using a multiple of standard deviation. This calculation is based on market volatility, which is a measure of how much the price is moving up and down. If the SMA trends up, indicating a rising average price, the bands angle up, reflecting the upward momentum. Conversely, if it trends down, signaling a falling average price, the bands follow, mirroring the downward pressure. The distance between the bands and the SMA is set by standard deviation, a statistical measure of price dispersion. This visually shows the degree of volatility in the market. High volatility, characterized by rapid and significant price swings, pushes the bands wider, indicating increased uncertainty. Low volatility, with smaller and less frequent price movements, pulls them closer together, suggesting a period of relative calm. The SMA remains the axis around which the bands move, constantly adjusting to reflect the current average price. Traders watch how price interacts with the SMA, observing whether it respects the SMA as support or resistance, or whether it breaks through decisively. Crosses above the SMA can signal bullishness, suggesting that the price is gaining upward momentum and may continue to rise. Conversely, crosses below the SMA can signal bearishness, indicating that the price is losing upward momentum and may continue to fall. The SMA can act as dynamic support or resistance, meaning that its role changes depending on the direction of the price movement. Price often bounces off it during trends, using it as a springboard to continue in the prevailing direction. This interaction provides valuable trading signals, helping traders to make informed decisions about when to buy or sell. The band's movement is always tied to the SMA's direction, ensuring that they remain relevant to the overall trend. The SMA's stability keeps the bands relevant to current price action, providing a reliable framework for analysis. Understanding this relationship is key to interpreting Bollinger Bands and using them effectively in your trading strategy. The SMA's role as a reference point cannot be overstated. It is the anchor that keeps the Bollinger Bands grounded in reality. Bollinger Bands excel at showing market volatility. When the bands squeeze together, it signals low volatility and potential for a breakout. Traders watch for these squeezes as they often precede big moves. When volatility returns, the bands expand rapidly, confirming increased price movement. Touching the upper band can suggest an overbought condition, but it's not an automatic sell signal. In strong uptrends, prices can ride the upper band for extended periods. Similarly, touching the lower band may indicate oversold conditions, but not always a buy signal. In downtrends, prices can hug the lower band for a while. The key is context. Bollinger Bands highlight extremes, but trends can persist. The bands help traders spot when prices are stretched relative to recent averages. They provide early warning of potential reversals or continuations. Volatility expansion and contraction are central to their use. Bollinger Bands make volatility visible and actionable. Always interpret signals within the broader market context. The SMA's simplicity is its greatest strength. It's easy to calculate and interpret, making Bollinger Bands accessible to all traders. The SMA smooths out erratic price moves, filtering out noise. This clarity helps traders focus on the real trend, not short-term fluctuations. Within Bollinger Bands, the SMA often acts as dynamic support or resistance. In uptrends, prices may pull back to the SMA before resuming higher. In downtrends, the SMA can cap rallies. The SMA's popularity means many traders watch the same levels, reinforcing their importance. This can create self-fulfilling support or resistance zones. The SMA's widespread use adds to its effectiveness. It's a reliable tool for identifying trend direction. The SMA's role in Bollinger Bands enhances its value. Its straightforward nature is a major advantage in complex markets. The SMA's biggest drawback is its lag. It reacts after price changes occur. This delay can mean late signals and missed opportunities. In sideways markets, the SMA can generate false signals, leading to whipsaws and small losses. The SMA gives equal weight to all data points, making it slow to reflect recent price action. Imagine a stock with very narrow Bollinger Bands, a squeeze. This signals low volatility and a likely breakout ahead. Traders prepare for a surge in price movement. The breakout's direction is confirmed by other indicators. In another case, a currency pair in an uptrend rides the upper band. The 20-period SMA angles upward, acting as support on pullbacks. Traders may use these pullbacks to the SMA as entry points. Bollinger Bands anchored by the SMA are versatile tools for analyzing volatility and price extremes. They help define relative highs and lows, and the SMA smooths the trend. But Bollinger Bands aren't a complete trading system. Combine them with other analysis and risk management. Know their strengths and weaknesses, the SMA's simplicity and its lag. Bollinger Bands provide context, not absolute signals. Overbought doesn't always mean sell. Oversold doesn't always mean buy. Use sound judgment and risk controls. These tools enhance your analysis, not replace it. Mastering them can improve your trading decisions. Always trade with discipline and perspective.